Hello and welcome to the lecture for the first part of Chapter 3. In this chapter, or in this lecture rather, I'm going to talk about prepaid items like supplies and things like that. I'm going to talk about deferrals in general, but in this section I'll talk about prepaid items and unearned revenue, two types of deferrals. In the next lecture I'll talk about financial statements and depreciation expense. So we'll cover that in the second lecture. So I want to go back to the first class that we had together where I talked to you about accounting being an effort to tell the truest story possible about what happened in a company's life or what happened in their month, their year, their quarter. And so adjustments are key to getting that story correct. And deferrals are a great example of that. Last chapter we talked about accruals, and that isn't a word that most people use, similar with deferral. So I have another word that you can think about that starts with the same letter. So an accrual, we're adding something to our books, because if we didn't do that, then what we're portraying happened isn't as accurate as it can be. An example of that would be all of you have worked for me. I've incurred some insurance or some salaries expense, and I owe you some money. I need to add that to my accounting records, or I wouldn't be telling an accurate story about this year. So I need to make an accrual to accrue that expense and accrue that liability, so I report the truth of what happened. Okay, so I need to add something to my books. The action happened, you worked for me, the cash is going to happen in the next period, so I need to add it to the books. Deferral is the opposite of that. It's where I want to delay recognition of something. I either pay cash in advance for something that will become an expense down the road, or I receive cash in advance of earning that revenue down the road later. So I want to make an entry so that I set it up so that I record the action, the impact of the action, either the expense or the revenue, when it's actually incurred, not when I pay it. Okay. So supplies are a really good example of that. Let's say we have a cleaning business and we're able to get a really good deal on buying a pallet full of 409 cleaning supplies. Okay, and we predict that we can use that 409 for the entire year, but we get a killer deal on it. So if I buy that 409 in January, if I expense it immediately, I'm going to make January look horrible. And then all the other months are going to look like I'm using free cleaning supplies. There's no expense at all associated with cleaning supplies in the other 11 months. So that would clearly distort the picture on a monthly basis of what's going on in my business. The same thing could be said if I buy a bunch of supplies in December. Should that make that year look really bad and next year look really good? So it's a timing issue. So in that case, those supplies are a cost. They're an asset that will become an expense later. So assets are resources that will be used in the future to generate income. I need that 409 to do cleaning that I can bill clients for. So as we consume that resource, it becomes an expense. And that's the key to matching expenses with revenues. If I'm charging people for my cleaning services and I'm consuming 409 when I'm delivering those cleaning services, then I certainly want those two things to be matched and be recognized in the same period. If I don't, I'm telling a distorted picture of what really happened rather than something that's closer to the truth. So in the example here, supplies are purchased for $5,000 in cash. So that's the first transaction there. Cash goes down, supplies goes up. That's an asset exchange transaction. And at the end of the month, I count the supplies that I have in the supply closet, and I determine that 3,000 have been consumed. And sometimes the book will say you count supplies at the end of the month and you see that you have 2,000 in supplies on the shelf. So then you have to do the math to figure out how much was used up. Other times the problem will just tell you how much is used up, like this does here. So when I use up those supplies, then I reduce my supplies, I reduce that asset because I now have less of it, and I reduced retained earnings by recognizing an expense. So that's one type of prepaid expense, is supplies. And I recognize expense as I physically consume it. And other type of prepaid expense are expenses that occur as time passes. So I might pay my insurance, say my car insurance for my business. I might pay that in January, and I pay it for the whole year in advance. Or maybe I pay 3 months of rent in advance or something like that. So then as time goes by, I'm going to reduce that prepaid expense and recognize an expense. The prepaid expense is an asset. So the example we have here is on April 1st, we buy a $12,000 12-month insurance policy. So when I spend that $12,000 in cash, I'm not going to recognize an expense at that moment because no time has passed. I haven't received the benefit of the insurance yet. So I record an asset, prepaid insurance, okay? So then as time goes by each month, okay, I'm going to reduce that prepaid insurance and recognize an expense. Here they're just making the adjustment at the end of the year for all 9 months. So they reduce the prepaid expense and reduced retained earnings to recognize interest expense. The same thing could happen. I used to have prepaid advertising where I would pay for advertising in advance. Well, I didn't want to recognize the advertising expense when I paid for it because maybe the advertisement wouldn't run until next year. And I want to record the expense when the ad actually runs because that is connected to sales that I make in that period. So I want to have proper matching. So we could have prepaid insurance, we could have prepaid advertising, we could have prepaid rent. There could be a variety of prepaid accounts. And I just have to be careful that I make sure that I look at each of those each month and recognize the expense that's appropriate and reduce those assets over time. Okay. So the other category of deferral is dealing with revenue. And this is a little bit tricky for students, so I want to take enough time to explain it here. So this is where I receive cash from a customer in advance of earning the revenue. So somebody pays me up front. When I get paid up front by a customer, in effect, I owe them back that money if I don't provide the service. So a good example of that would be, let's say that I buy a season ticket for the Seahawks and I pay $1,000 for my seat. And the typical season is 10 games, 2 preseason and 8 regular games. And so what I get in return for my $1,000 is the ability to go to 10 games. Now, if you were the controller at the Seahawks and you received $1,000 from Tim Madeley, you would debit cash, or excuse me, you would increase your cash account and you would create a liability, which is called unearned revenue. So the Seahawks owe me back that $1,000 in the event that they don't have a season, okay, which actually happened this year. So you can't attend games in person. Seahawks refunded people's money. So if the games don't occur, they're going to send me a refund. So they have a liability on their books until they earn it. They earn it by playing games. So in that case, each time they play a game, they would reduce that liability. They now owe me less money. If they played 2 games and then canceled the season, they would owe me 80% of my money back. Okay, so each time they perform and earn some of that revenue, they reduce the liability and recognize revenue as it goes. So at the end of the season, they would have recognized all $1,000 of revenue and the liability would then be 0. They wouldn't owe me any more money because they've satisfied their obligation to me. So let's take a look at that. And I would say that, you know, there's symmetry here. So if I had a business and I was buying Seahawks tickets maybe to give to my employees as a bonus or something like that, it would be a prepaid asset on my side, right? It would be prepaid Seahawks tickets. And on the side of the Seahawks, it would be unearned revenue. So we would have some symmetry, and I would be recognizing the expense as the games are played. They'd be recognizing revenue as the games are played in a perfect world. So let's take a look at an example here. So on November 1st, we receive an advance payment of $6,000 for consulting services. So I increase cash by $6,000, and I increase this new liability called unearned revenue on my books. So I have a liability that I've created. At the end of the year, we determine that $4,000 of the services have been provided. So I reduce that liability by $4,000, and I increase retained earnings by $4,000 to recognize revenue. So please look at the video separately here for the practice problems, and that'll help you with your homework. I'll record those and upload those shortly. Thank you very much. Talk to you in the second part of the lecture.